What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 13th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I gotta go on yet again another rant and rave here, because we gotta talk about not only everything that's been going on with SVB or Silicon Valley Bank, as well as the stablecoin depegging we saw over the weekend, but also talk about how the contagion is continuing to play out, folks. I'm not trying to get you guys to panic. I'm not telling you to go run to the bank. I'm trying to let you all know here about the concerns that play out in regards to the crypto space and how this will likely not just play out in the broader traditional financial markets, but how it will have an impact on risk on markets like crypto. This is going to be a jam-packed episode, so if you guys can, stay tuned for it. And if you guys enjoyed the video, consider dropping a like. It's one of the best ways you guys can support the channel. So let's go ahead and kick off the rambling. Now, I usually dive straight into the analysis on Bitcoin. But today, we need to first try to understand what's been going on here over the past week. Later last week, it was realized that Silicon Valley Bank, one of the largest banks in the United States, a top 20, 30 bank in the US, with over $200 billion in assets under management, unfortunately went under. And now this isn't something that I want you guys to just be too panicky about. I want to try to give some color and some context to it. But it is a serious concern for the broader financial system, as we'll talk about later on as we go throughout the video. The situation SVB caught itself in was a situation of a liquidity crunch. It did not have enough deposits or readily available cash to meet to the need of creditors or people who have deposited within the bank, people it owes money to who have deposited liabilities or capital money into the bank, right? Really simple stuff. We can use all complex financial terminology, but generally speaking, people would put money in the bank, and SVB did not have the money to meet to those people who wanted to withdraw their money. The reason being, over the last decade, SVB got itself exposed to a lot of fixed income products. Fixed income products are things like bonds or mortgage-backed securities, forms of debt that are ideally supposed to pay you some kind of interest or yield over time and eventually return you the base principal of the capital or value of those assets, right? That's the general thesis of how these work. Now, if SVB had Treasury notes, which are kind of seen as this guaranteed asset by the government. Essentially, if Treasury notes stop getting paid on, then you can kiss goodbye to everything in the financial system. That would be a little bit of a better scenario. However, in the case of SVB, they own a lot of mortgage-backed securities. Now, I understand many of you immediately think that these are the exact same assets that were around in 2008. And while they are the same structure of assets, they are essentially a basket of mortgages or home loans that are being paid over time and securitized into a financial investment vehicle and do pay some kind of yield. These are likely better quality loans than what were seen in 2008. I want to go ahead and dispel that FUD there, right? So we need to understand that it is the same kind of product. I'm not a big fan of this. I don't think this is a good thing. And at the end of the day, we will talk about how there is still going to be risk associated with banks like Silicon Valley Bank, who chose over the last decade to buy up these type of financial assets. They are not risk-free. And I want to make something very clear. According to the statistics, not all of them, and the vast majority of them for that matter, are not guaranteed by the government. I want to make that very clear here. I know some people have that assumption. Mortgage-backed securities are absolutely guaranteed by the government. That is not true. We need to go ahead and talk later on about why this is a big deal. But the key thing is this. SVB did not have the amount of dollars to meet the withdrawals, and that left them, as I mentioned, in a liquidity crunch. Luckily, the FDIC and other federal branches of government are going in to actually mitigate the situation, to secure depositors, to stifle any potential fear or concern, and most importantly, ideally prevent any kind of contagion across the economy. We obviously don't want a bank run. We don't want to cause any type of major disturbance in our financial system. I'm right there with all those who are championing for that same narrative. And no, SVB doesn't need a bailout at the end of the day. What SVB needs is for its depositors to be made whole again. And the FDIC is taking control of that. Now, I want to go ahead and talk about something here. We'll come back to SVB later on, but why is this so important for the crypto space? Well, it has to do with the exposure that major stablecoins like USDC have to banks like SVB. If you guys know, USDC is backed by one of two things: either dollars in a bank account or security notes. More specifically, treasuries, US treasuries that have some type of maturity, pay some kind of yield. And this is how Circle, the company who created USDC, makes its money, by having yield generating treasury notes or dollars in a bank account getting some kind of yield, and having the IOU tokens or USDC given out to those who have deposited money or treasury notes inside Circle. Now, the thing about this is that Circle itself has a certain limit of its exposure to dollars. It has the vast majority in treasuries, and those treasury notes need to be sold in order to provide, or they need to reach maturity in order to provide that liquidity for users. Ideally, not everyone is going to run to the bank and withdraw their USDC. But over the past weekend, there was a huge amount of people coming in to claim their USDC. And of course, not enough dollars to meet that. Hence, the freeze on allowing people to claim their USDC, causing this mass panic. However, it is clear by now that the FDIC is going to be stepping in, providing some degree of relief, and that has cooled concerns for a lot of investors. We don't have all the details of what this means, but we do know that Circle has about a $2 to $3 billion exposure to the overall SVB bank. So I want to go ahead and talk about why I really dislike the reaction people are having. So many people are saying, no, the FDIC is going to come save us. This isn't Terra Luna and UST. Why is there all this noise? Anyone out there who's signaling concern around this is fudding. Stop all the concern. You're causing more damage than good. Really? I want to go ahead and signify one thing here, guys, which is anyone who is telling you that right now. I'll say this. We sent this in the Dash Report Alerts group back a couple days ago. And I'm going to say it very proudly here on this channel. If anyone is telling you that this is not a reason to be concerned to some degree, that it's okay to just buy the dip on USDC and have large sums of your capital in stablecoins right now, unfollow them. I'm all for different opinions. I'm all for people having a different point of view. But I got to tell you guys, I really hate this kind of petty over exuberance and optimism in a risk-off environment. Seeing USDC peg and DAI depeg yesterday down to around 87 cents, and still seeing that it's not easily sitting at $1 per coin, knowing that there's still systemic risk, is a childish thing to do. It is not the kind of thing you want to do in order to protect and preserve your capital. When we are in a situation where major banks like SVB, or, as we're going to talk about later on, an even bigger Domino, which has just fallen this morning as of the recent reports we're getting. Pre-market, it's down 40-50%. There are other banks that are not in a stable position, and people are promoting you to go out and buy the dip on altcoins until it fills its gap up to $1. This is absolutely terrible advice. It's terrible risk management. And I have to say this, it really for me is something that I'm very opinionated about, because as we've talked about in this channel, it is not about what you can make in investments or trades. It's about what you can afford to lose. And folks, if these stable coins do not start to continue holding back to that dollar pair, if we do not get more reassurance here over the next few days, and if we see further contagion in the banking system, the last place you're going to want to be is in a stable coin. And it's not time to be chasing every single dip opportunity, every single rally in Bitcoin's price, right? We need to talk about this here, right? First off, overall, Bitcoin in the long term has been in a general downtrend. It is still facing resistance between the major resistance points and its line of resistance. And we are well extended beyond the general line of previous support that's been formulated between the January, June, and November lows. Not to mention, we are setting in lower significant highs. We are continuing to see weakness in price. And if we turn on our indicators here, not only are we still well below that 200-week moving average, the indicator that so many people were confident we were going to clear through, but on top of that, we are struggling to hold on that 200-week moving average. We got to bounce up here, and it's going to be a question of whether or not we're going to be able to clear through that 200-week or 200-day. There's no need to trade this. And once more, as we've talked about here on the channel, if we take a look at that market order flow, while we've seen price surge back up here towards a similar range we were at back on March 7th, look at the market order flow. understand the market structure here, guys, we have seen still across the board on the macro order book this is Bookmap's multi-book tool, which allows us to see the market order flow across a variety of order books and exchanges. We are seeing a net outflow of 9,200 on the CVD, the cumulative volume delta. This is typical thin order book manipulation and thereby distribution, where strategic institutional investors take advantage of people buying the dip. Time and time again. That is why price has been in this formation since back in January, and why it has not been able to clear through that 200-week moving average. There's no other details we need to consider here, folks. Price action's not strong. The macro environment is concerning. What more do we need here? Now, I want to go ahead and talk a little bit about what's going on here in the broader markets. We'll give our long-term thesis here for Bitcoin. But folks, futures were up about a percentage or more here just a couple hours ago. They are now down to practically flat. Whether you're looking at the S&P 500, if you're looking at the NASDAQ, you can see here over the past few hours here, we've seen those gains fade. The Dow Jones is actually down 0.3% this morning. And if we just zoom in here to the ES, which is the futures, the E-mini futures for the S&P 500, all those gains we had made last night and the futures markets have now faded essentially. What's going on here? What we're learning now is that SVB is not the only domino that could start to tip things over. We have an even larger bank now that has spooked the markets. It is not just the broader downtrend here in the financial sector. It is not just the VIX continuing to spike even higher here this morning than where it closed yesterday. We have to take a look at no further than First Republic Bank, down over 47% this morning. And once more, I want to reiterate that this is not just some small mom and pop bank. These regional banks, the people somehow are negating as small players in the financial system. In the case of First Republic, they manage over $212 billion in bank assets. Their total wealth management is $271 billion, making them a top 25 bank in the United States. A bank that has been profitable for 36 consecutive years, now potentially in the brink of being in the exact same situation that SVB found itself in. Being overexposed to mortgage-backed securities, being overexposed to these different types of income-generating products, rather than doing what banks should do, which is facilitating lending activity. If they can't, they don't pay the yield. It's as simple as that. Now, we don't know all the details here about First Republic. I don't want to speak too soon, and I don't want to cause the unnecessary panic, but I want to go ahead and emphasize something here. Not only the developments of news that we're getting here that the UK branch of Silicon Valley Bank was just acquired for $1, essentially, £1, by HSBC. So if that tells you anything about the bidding potential of Silicon Valley Bank, someone saving this bank, right? Doesn't matter if the depositors are made whole. I'm not here to talk about that. I think the FDIC is going to do its job. People don't have to worry about that. What has to be a concern is that a major banking entity that was once worth billions of dollars is now worth $1. And other banks as well are going through the same exact fate, now down 55% here in the trading pre-market. A previous $15 billion bank is now going to be worth $7 to $8 billion less. And that's just with where it is right now. So this destruction of equity value has a major effect on the broader financial system. People who own shares in these companies are now in a risk-off mentality. And it is weighing down the broader financial sector, not just the XLF, but a much more important ETF that you guys need to watch, which is the IAT, the Regional Banks iShares ETF. And the drop we saw on that the other day was massive, 17% in this week alone. If we go down into the daily time frame, I don't know how things are going to play out here. I think in the AM people were thinking we were going to get a gap up. But guys, follow the sell orders here on Lux Algo. Look at the volume and the free fall in price. There are more banks that are going to get caught up in this. Now, I want to go ahead and talk about why this is a big deal here, right? I know I've rambled on a good amount here. Why is it that this is going to continue to weigh down the broader financial system? Well, let's just go ahead and first understand something here, a big misconception people have. When it comes to quantitative tightening, this is not just some arbitrary thing the Fed does in the background. The Fed is doing the counter opposite of what they were doing over the last decade. The last decade, they were buying up any type of financial asset, whether that be treasuries or more specifically, mortgage-backed securities. This was a huge dynamic of quantitative easing. And that basically was the Fed buying up mortgages, which allowed, not only with interest rates down near 0%, but allowed mortgage rates to decline and dwindle to such a high degree where banks were giving out mortgages to practically everyone. To a large sum of the population, these mortgages that were initiated by banks were swiftly moved over to Fannie Mae and Freddie Mac. These are government-sponsored entities that bundle up these mortgages and turn them into mortgage-backed securities. They're some of the few major entities that do this as their core business model. Now, we are seeing the counter opposite. Rather than massive generation of mortgage-backed securities and continued buying efforts from the Federal Reserve injecting liquidity into the economy, they are now doing the counter opposite. They're not just sitting on their hands, they're dumping these month by month. They are selling U.S. treasuries. And on top of that, they're selling mortgage-backed securities. They've been a net seller since back in April of 2022. Now, a lot of people think that these mortgage-backed securities hold some kind of consistent value in the market. But that's not true. Mortgage-backed securities decline when they're sellers, and they rise when they're buyers. Notice here how for the last decade where the Fed has been a guaranteed buyer, you'd be silly to bet against mortgage-backed securities. If you're looking for fixed income products, that was the way to go. That's what Silicon Valley Bank thought at the time, and probably many other banks who unfortunately had so much cash on their balance sheet due to the Fed's quantitative easing, and they just didn't know what to do with it. So they bought fixed income products. Bond yields weren't paying very well as yields are going down. Might as well go for the fixed income products like mortgage-backed securities. Well, a lot of banks were convinced during 2020 and 2021 to keep buying these things because inflation was transitory. The Fed wasn't going to have to do anything. Well, the Fed came in with the fastest rate hike in history. And that is going to cripple the ability for people to pay back on their mortgages, which therein leads mortgage-backed securities to be worth less. Not worthless, but worth less. I mean, this is a very important dynamic to understand. The Fed, first off, overall, whether or not you guys think these will get paid back or not, there's just a net seller now of tens of billions of dollars. And there needs to be buyers to give them some kind of float or ability to remain at some kind of valuation. So if there aren't the net buyers there, these are just going to continue to go down. And they're going to put a lot of banks who bought these types of assets at risk, not just in regards to their yield, but on their core principal value. So that is a really big concern we need to be wary of here, right? There's not an absolute guarantee that this is all going to play out just fine. And I think markets are starting to realize that now. I think we're starting to see that in the IAT, that there is a massive liquidity crunch, but not just that, there is a major risk that some of these banks are going to get themselves caught short. They are not going to be able to meet all deposit requirements. That's the really scary reality that we have to face here. It might mandate that the Fed has to step in, and we might finally have to address the long-term concerns that mortgage-backed securities bring to the financial economy, and how securitization of mortgages probably isn't the best idea, or at least it shouldn't be seen as this kind of, safe asset at the end of the day. No problem if people want to generate them and speculate on them. By all means, go ahead. But you shouldn't be taking my deposits or your deposits or anyone else's deposits and buying up these financial products. Banks should be doing what they always do best. They should be lending capital. And if not, they should be maintaining healthy reserve ratios and not engage in speculating on different types of securities and financial assets. Plain and simple. Now, bringing this back here, I know I've rambled on a good amount here today, guys. I mean, I'm sorry, but the big point I want to drive home here is the long-term thesis for Bitcoin. I know a lot of people are eager to chase this rally that we saw over the past few days. We did bounce up from around 20,000 to 22,000, it's about a 10% move here. I want to go ahead and just zoom out here. For those of you who want to know what I'm thinking on the market, what I'm thinking about here is the fact that we can't get above the 200 week. That the significant previous 2 points of resistance lined up here are exactly where price weighed down here in February. And once more, we need to take a look no further than the Lux Algo indicator here. Now, I know this can be a bit overwhelming for you guys here, but we've got a custom modification on the price action concepts indicator. And I want to go ahead and talk about how powerful this indicator can be, whether it be on shorter term timeframes or longer term timeframes. I personally like to look at them on the longer term timeframes, and you can do exactly what we're doing here on a whole range of different charts. It's the cool thing about these indicators. So I want to go ahead and talk here specifically about fair valuation ranges, otherwise known as fair value gaps. Now, it would probably take me an entire video on itself to explain what fair value gaps are and to dive more specifically into the price action concepts indicator. But I just want to show you all here real quickly today how this can be incredibly valuable at spotting when we finally got into our typical capitulation range. Now, if we take a look at the last two bear markets, we see a relatively consistent trend. We see that the last fair value gap, these green bars that stretch out across the screen, are usually where buyers come in and signify the lows of bear markets. Same here as well as we take a look at the dip in March of 2020, exactly where buyers came in here. Along with that, if we take a look at the prior bear market that started in 2014 into 2015, the major fair value gaps here and here were the levels where price retested. Now, if we take a look and utilize this as a model for this bear market, while we have created some fair value gaps here within this range in January, a bit of an anomaly with the fast rally in January, we have not gotten a retest of those two significant levels here around 14,500 and coming all the way down here to 12,500. This is why, again, we have echoed these kind of price points here in the channel. And while we're not absolutely certain of anything, we don't want to speak in absolutes. My main point is this: we have likely yet to see our final wave of capitulation. If you guys think the lows back in November had to be the absolute lows just because of the rally we've seen here in January, that is the same type of thinking we had back in June of 2022. We cannot get above the 200 week. Price action is not signaling significant confidence or significant follow through for that matter. And we have got a very concerning macro environment that just doesn't favor risk on assets like Bitcoin. You've got a Fed that is tightening monetary policy. You have banks now that are in potential risk of insolvency. This is not the time to be basking in risk on assets or using leverage. It's a time to stay in cash. And as we have said for months here on the channel, have your money in a secure bank. Don't chase yield right now. Simply have it in the most defensive plays. And it's clear by now that even stable coins may not be one of the safe vehicles that we can rely on. At least not for now. Until we see a consistent remaining of that peg, I'm not holding any stable coins. And if I have any, I'm looking to get them into cash ASAP. Now is not the time to take excessive risk. Instead, right now, it's the time to start preparing for that next cycle, to start looking for the plays that are going to lead the next bull market. Doing your due diligence and your research now more than ever is so important. One of the projects that we are excited about here on this channel is none other than Kryxivia. This is one of the play-to-earn games within the crypto space that I'm genuinely excited about. And the great thing is, as I mentioned, it's free to play. You guys can test it out. It's got a real game. It's not just some white paper. They're really building an exciting ecosystem with hundreds of active players on a day-to-day basis already here in this bear market after launching their beta just a couple months back. And they're continuing to develop, build partnerships, and continue expanding their community. One of the big things that is very important is that if you guys are looking for an altcoin in this space, if you're looking for exposure to the Polygon ecosystem, if you're looking for a game that's actually delivered, that's got real community development, and is long-term going to set real demand for the project and the token itself, then I definitely recommend you guys check out Kryxivia. They've just recently announced back here in February, and they're going to have more developments here in the month of March about their staking program for KXA, which is the native governance token for the Kryxivia ecosystem. So I highly recommend you guys take a look into that staking development. Follow them on Twitter if you aren't already. They've also as well added a new partnership here in the month of March with Miria, which is a major player when it comes to the infrastructure of Web3 gaming platforms, allowing for high scalability and zero gas fees. So this is going to be playing a role in the overall structure or infrastructure of the Kryxivia ecosystem. And last but not least as well, there's been some really great developments. First Play here put together a really good summary of what's going on in the Kryxivia ecosystem, how the game plays out, some of the major partnerships they have, some of the metrics, and some of the roadmap developments for the project that I highly recommend you guys check out. Kryxivia is one of our long-term partners here on the channel, and I'm really excited as someone who's played RuneScape, who has played MMORPGs in the past, and also games like World of Warcraft, that are going to allow this game to really build a large ecosystem and ideally its own economy long term. So again, this is something that whether or not you guys think it's an interesting project to invest in right now or even just become a part of, I recommend you guys do your own due diligence, try out the game, give it a go, and really see whether or not you find the game fun itself. Because if the game itself is fun and they've relatively got the token economics right, this is definitely going to be a project to watch going into the next cycle. But I care much more about the fundamentals. I love seeing how the team is continuing to build, and it's one of many projects that we've talked about here on the channel that I think you guys should definitely keep on your radar. But that's it for today's video, guys. If you want to get access to Lux Algo or Bookmap, you guys can get a 30 to 20% discount off at the links down below in the description, utilizing the specific discount codes. And you can also check out Kryxivia down at the link down below in the description. I hope you guys enjoyed this video and the topic we talked about today. If you did, consider dropping a like. It's one of the best ways you guys can support the channel. There's so many interesting things going on now. I know it's a difficult period of time with a lot of uncertainty, but the best way we can handle it is by being prepared and assuming the worst case scenario. Once we know when the good times are here, when the Fed is back on our side, we can get back to risk taking. But for now, we've got to preserve our capital. It is rule number one for any smart investor in this environment. And this is where we stand out, where a lot of people are so used to the good times, we know how to trade both types of environments, bull markets and bear markets. That's it for today's video, everyone. I'll stop my rambling here. Take care, and I'll see you all in the next video. Take care, everyone.